Now let's get to a big warning from a big bear. Investor Jeremy Grantham says the stock's super bubble that he warned about previously has yet to pop. The GMO co-founder sees more trouble ahead due to what he calls a dangerous mix of overvalued equities.
Approach and preempt calls on market bubbles draws parallels between the current market conditions and historical crashes such as Black Thursday in 1929, when $4 billion was wiped off the market in a single day, and the burst of the com bubble in 2000, both of which led to significant market downturns. And in 2021, we witnessed a 10% hit, leaving many investors on edge. And here, the US stock market is once again bumping up against all-time highs, and this has granted them warning that the market is dangerously overvalued.
You were well known in the investment world for saying that sometimes there are bubbles and bubbles should be avoided. Do you think we're in a major bubble now, right now in the United States, and do you think that the tech bubble has burst sufficiently so that the tech bubble burst is over?
I think we are descending from the 2021 bubble, which was one of the great bubbles. And this should be normally the deflationary period, the deflating period, which is a function of will the earnings decline, will profit margins decline, will the economy go into recession, and we will have a recession running perhaps deep into next year, and an accompanying decline in stock prices.
So the recession that you're predicting is probably not going to happen in 2023, but maybe...
It may start in 2023.
So what does all of this mean for investors? How can you not only survive, but thrive in the face of a potential market crash? Well, Jeremy Grantham offers a unique perspective, buying assets to survive and get rich in a crash anthem strategy. Involves strategic asset allocation and a keen eye for opportunities during market downturns. In this video, we will explore his insights and explore practical steps that you can take to protect and grow your wealth amidst economic uncertainties.
I suspect that they will once again dominate, and we will have a recession running perhaps deep into next year, and an accompanying decline. The trend line, being slightly generous, is 2,500. And most of the great bubbles, the super bubbles, go below trend and stay there for quite a while. In the Greenspan era, that tendency stopped. In 2000, yes, the NASDAQ came down 82%, which was fairly brutal. Amazon came down 92%. But the Federal Reserve raced to the rescue so loudly and strongly that they stopped the decline in the S&P at trend line. It only declined 50%. 50% is a hell of a big decline, but it was only enough to get it back then to trend. This time trend is at most 2,500. And I would expect, even if the Federal Reserve tries to do the same, it will be hard to prevent the market from declining.
Jeremy Grantham recently issued a cautionary warning about investing in the US stock market. He expressed concerns that if certain challenges arise, the S&P 500, a key stock market index, could potentially experience a significant drop of over 50%. Jeremy Grantham's cautionary stance on the US stock market, particularly the S&P 500, revolves around several economic indicators. Firstly, the colossal US debt of $33 trillion raises concerns about the country's economic stability. High levels of debt can potentially hinder economic growth and impact investor confidence. Secondly, Grantham highlights elevated interest rates in the US. An increase in interest rates can lead to higher borrowing costs for businesses, potentially squeezing their profits and causing a ripple effect in the stock market. The mention of unsustainably high yield levels suggests that Grantham is wary of investment returns being too optimistic or unsustainable. This could imply that current market expectations for returns may not be realistic. Signaling a risk of market correction, Grantham's apprehensions extend to the real estate and mortgage sectors. The US housing market has faced various challenges, with the Great Depression of 2008 being the only instance resulting in a significant drop in home values. The housing shortage in the US has led to a heightened demand surfacing. The number of available properties for purchase or rent as mortgage have increased, and housing affordability has decreased. More people are comp.